again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is November 14th. It's a Tuesday of 2023. Thanks for watching our market insights and observations. We're going to talk about the three topics Wall Street's paying attention to, so you should be too. Thanks for watching. Well, right out of the gate, we have cooler inflation as expected. It's welcome news. We have the equity markets in rally. We have bond yields or interest rates retreating. So that's sort of a bond rally as well as an equity rally. Now, why would that be? Essentially, let's get right to it. The U.S. CPI reinforces that the Fed can stay on hold for their December meeting. Remember, they just stopped sort of their interest rate regime of raising interest rates just about every single Fed meeting over the last 18, 19 months. Last month, they paused, actually. And so they said, we're going to be data dependent. We're going to have to be higher for longer. But this is welcome news right now because inflation has been extremely stubborn. And it's been a situation where we have all been looking for that. Wall Street has specifically. So bottom line is that reinforces the decision that the central bank can remain on restrictive hold and basically making certain that the CPI drops below the 4% versus this stop and going strategy. We'll talk about the dangers of stopping and then going again, essentially what we saw back in the 70s. And that was sort of a double dip that we saw there in regards to markets and then inflation rising several times. Now, here is the biggest issue, and I'm going to continue to reiterate this. This is what the market fears the most, meaning equity markets, bond markets, even the consumer, if you will. And this is what the Federal Reserve is trying to avoid. Now, if we look at a historical look at inflation, very specifically, the CPI, inflation tends to come in multiple waves historically. It actually comes 87% of the time that inflation in this blue line right here is where we are today, okay? So now we have inflation needs to be around this line right here. Let's go green because this is what the Fed target is. It's basically at the 2% rate. So we're getting closer, right? The trend is our friend. But the concern here would be is that this bounce, does this time look different? Does it stay down here for a long time and not go back up? Well, one thing is right in here is the recession. Last 5 times, historically speaking, this has been recessionary, right? Employment has spiked up and sort of wages have come down, and that's relieved the pressure in the system, and consumption's calmed down because inflation has gone basically under control because everything costs more, right? And so that's what the Federal Reserve's doing with raising the interest rates and just trying to basically limit the demand and bring it down very specifically. Now, with anything, there are ways that markets they can control and markets that they can't control. One of the markets that they can't control is housing at this moment in time. In fact, we just attended this morning the Palm Springs Life basically market update, and they talk about the Coachella Valley, all basically 9-10 cities here, and talking about the real estate market specifically here in the Palm Springs area. It's a microcosm of the United States, but it also is indicative of what's happening. Right now, the month-over-month listings for homes to be sold, usually it's about 1,270 on average. So every month, you have about 1,200 homes that are listed for sale. Right now, you're looking at 937 homes on average. So that's a decline of basically 26%, and that trend has been getting worse and worse or more magnified. Why is that, Rob? How's that an issue? Well, the biggest issue is that if you have less inventory, that's going to increase the demand. It's going to push prices up. So housing affordability is going lower and lower. And even though with the stubborn interest rates at 7.5%, 8%, that could provide some relief, but that relief is going to increase and incentivize more buyers to come in. But at this moment in time, it's an inventory issue, not only here in the Coachella Valley, but across the United States. So that's the real issue that everyone has to pay attention to. And I don't think the Federal Reserve can produce more houses right now. So that inflation is going to be built in and anchoring. Now it's going back to the 70s. The Fed cuts are, why the Fed would be in a tough position today to cut interest rates. There's basically Fed funds futures are pointing to next summer of about a 50 basis points cut because we are basically headed squarely in recessionary territory as consumption and consumers are feeling consumption's down, and consumers are feeling the hurt right there. But in the 70s, so all these gray bars here going back are all the recessions, okay? And what the pattern looks like is exactly where we're going to be today. We're going to receive a recession. Now, you don't know you're in a recession until 6 months later when they come out and say, oh, by the way, we were in a recession. But the setup is basically, as you see, unemployment's rising all across the board here. And that's what the Fed wants, is the unemployment rising. And that's basically trying to slow down, and that, the recession's not always bad, if you will, but at the same time, because it relieves the pressure in the system, wage inflation and so on and so forth. So right now we have the biggest challenge was stagflation in the 70s, and it was a start and go basically policy where those waves of inflation kept going. Things could be a little bit different this time. I'm not saying that we're not going to repeat the 87% sort of second wave of inflation. That remains to be seen. It's our biggest threat, I believe. That being said, we do have technology that's implemented today. I think AI and a few other efficiencies for corporate America to work their way through. I think supply chain's a lot quicker and faster than it ever has been. So there's that efficiency in the economy, and the economy to basically grind through what could come our way versus the 70s. So I think there's corporate America, we could still see multiple expansion, meaning increase on the bottom line, because they would lay off people or workers or do more with less. Profitability will still be there for corporate America. Now, why is that? Think about that. Everything from cereal to ice cream is shrinkflation. They shrink the box, they increase the price, and then as their internal costs go down, maybe not labor so much, but let's say all the goods and services, goods and sold to go down on that, then their profitability is that margin expansion is still there, sometimes even greater than it was when we first started out a few years before inflation and recession hit. So we got to keep an eye on earnings and how corporations are able to navigate these lean times. That means that if you look at this, S&P 500 has grinded its way higher. That's the chart that you see on the way, all the way through, basically the markets going through, or the economy going through many recessions and maybe sort of a lot of these tensions throughout the years. So, but the U.S. S&P 500, the top 500 companies, have the ability to sort of navigate their way through sort of the pressures in the economy and still increase profitability. So that would be the key here. That's our update for today. Thanks for watching, and we'll see you again next time. Take care. Have a great day.